This video is an Uncover Japan company research report on Nippon Yakin Kogyo, ticker 5480. This 100-year-old specialty steelmaker is unusual because it smelts nickel, melts and rolls alloys, finishes them, and supports customers inside one corporate boundary. The investment question is whether a recovery in high-performance materials can turn that integration into steadier earnings and close a deep valuation discount. The report scores Nippon Yakin 15 out of 20, 4 for growth, 5 for value, 4 for macro fit, and 2 for supply and demand. At the report date, it traded around 5.7 times forward earnings and 0.62 times book, with a dividend yield near 4.9%. Those numbers are cheap, but not free of risk. Earnings swing with nickel prices, Chinese demand, product mix, and an illiquid small-cap shareholder base. What does the company actually make? Ohayama Works smelts ferronickel from ore and recycled feedstock. Kawasaki Works melts, rolls, pickles, finishes, and ships stainless and nickel-based alloys. The differentiated end of the range includes 44 high-performance grades, used where corrosion, heat, or chemical exposure makes failure expensive. Semiconductor equipment, solar plants, flue gas treatment, desalination, marine structures, and emerging hydrogen systems. The headline financials show a violent cycle. Revenue rose from about 112 billion yen in fiscal 2020 to nearly 200 billion in fiscal 2022, then fell to about 151 billion in fiscal 2025. Operating profit peaked at 29.3 billion yen and reset to 11 billion. The boom combined strong demand with nickel inventory gains. The downturn combined weaker China demand, a lower high-performance mix, and inventory losses. Operating profit and net income move sharply together through the nickel cycle. The most important accounting distinction is reported operating profit versus profit excluding nickel inventory effects. When nickel rises, older inventory creates gains. When nickel falls, it creates losses. Those swings can move reported profit by several billion yen without saying much about factory execution. The report therefore uses the X-inventory line in the underlying research to separate operating performance from commodity revaluation. The moat sits at both ends of the value chain. Upstream, Nippon Yakin is the only Japanese steelmaker with its own ferronickel smelter, and recycled feedstock reached 58.3% in fiscal 2024. Downstream, a broad alloy menu and technical support help engineers select materials for harsh environments. The middle steps are necessary manufacturing assets. The harder-to-copy advantages are raw material integration, accumulated metallurgy, short lot flexibility, and customer application knowledge. The balance sheet is stronger than it was at the start of the cycle. The equity ratio has risen to roughly 46%, and net debt to equity has fallen to 0.7 times, already inside management's target range. Return on equity, however, remains below the 10% ambition. That makes the next phase less about survival and more about whether new investment and a better product mix can earn an adequate return on the capital base. Cash flow remains positive, but the company is entering a heavier investment phase. The fiscal 2026 to 2028 plan includes strategic spending on new alloys, semiconductor and hydrogen applications, and lower carbon smelting, alongside necessary plant renewal. The test is not whether Nippon Yakin can spend. It is whether that spending raises the high-performance mix, supports pricing, and produces returns above the cost of capital. Management's central goal is to lift high-performance materials from 44% of current sales back to 60% by fiscal 2028. That means winning more demand in India, semiconductors, hydrogen, desalination, and other technically demanding markets, while reducing reliance on general stainless and China. The direction is coherent, but the prior plan also missed its mix goal. End market recovery is only partly under management's control. Valuing a cyclical on 1 year's earnings can be misleading, because its price-to-earnings multiple often looks lowest at peak profit and highest at the trough. The report therefore combines historical earnings multiples, price-to-book, and the dividend. Nippon Yakin's 6-year average earnings multiple is about 5.6 times, while the stock remains far below management's 1 times book ambition. The discount reflects real cyclicality, small size, China exposure, and uncertain timing. The report's author estimated 3-year scenarios range from 2,250 yen in the bear case to 7,000 yen in the bull case, with a base case near 4,550 yen before dividends. These are not forecasts or price targets. They illustrate how much the outcome depends on the high-performance mix, China demand, nickel effects, return on equity, and the valuation multiple investors eventually assign. In summary, Nippon Yakin is a rare integrated nickel alloy specialist with a real technical moat, a repaired balance sheet, and a dividend supported by a 2.8% dividend on equity floor. It is also cyclical, undercovered, and exposed to China and nickel. The indicators to watch are the high-performance mix, new orders outside China, operating profit excluding inventory effects, return on equity, and delivery of the defended dividend. This is background research, not investment advice. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.